So the memo format, I already handed out the memos to you. There's some extra memos over there if you want to grab them, take pictures of them. What I would do is focus on really the format, but if you can delve into and start doing the analysis, that's even better. Okay, the memos are extremely powerful. There's a lot on that one page. And again, it's going to take iterations to go through it with me and through this course, but by the end of the semester, you'll have 5 perfectly written and logical memos to be able to utilize. So first, the font is Times Roman, so no Arial, Times Roman, and it's in 12-point, okay? The 1-inch margins around the borders, but if you're going to 2 pages, you can bring up the margin on the top and bring down the margin on the bottom, but don't go to 0.5. Okay, it's too narrow. It looks kind of goofy. The memo should be in caps and it should be bolded and in 20-point type. I think we were using 16 or 18. It looked a little small. You want it to, stand out so that people know it's a memo. Date to from RE, which is basically the subject line. You have colons on the other side, and then you indent and make sure that it's flush, so that the date and to me from you, and then what you're going to be talking about is all flushed within the page. The first line is just like a line that you would read the Financial Times or the financial section of the New York Times or the Wall Street Journal. Stock prices to drop 9% over the next 3 months. For students, do not use decrease, do not use increase, okay? In business, you don't use increase and decrease. It's too, how do you say, a soft? I like to say drop, rise, fell. Just very sharp language. Stock prices to drop 9% over the next 3 months. That basically grabs you and says, first thing you ask is why, because that's a lot. That's a pretty big deal, right? Stock prices to rise by 9%, stock prices to drop by 9%. Oil to drop by 10%. I mean, these are some pretty bold statements, and what it does is it grabs and captures the reader and locks them in, and basically makes them want to read the rest of it. Then on the next line, and this is exactly the way you want to say it, so the only thing that's really going to change is maybe the forecast and the factors, and maybe the trades, okay? But the format should be replicated, okay? It's a standardized product. I read like 60 of these a week. I could read up to 120, and with all my classes, I could read up to 500, okay? They need to be standardized so that I can communicate and go through those very quickly, pull out the information that I want, and then be able to understand what you're trying to communicate. So this is just stocks, and you're going to replicate it again across oil and gold and bonds and US dollar. We are tracking stock prices, period. We forecast stock prices to drop 9% over the next 3 months based on the following factors, semicolon. You want to bold, drop 9% over the next 3 months. You want to bold that so that it stands out. The factors you're going to have to come up with, we'll talk about supply and demand factors that drive these asset prices up and down, but you're going to have to put those factors in there, and I'll leave that up to you. Therefore, comma, we recommend the following 36 trades. You got to have at least a minimum of 36 trades. You can have more than that if you want to spend more time and do the research, but you got to have at least 36 as a minimum trades. Then you basically have the derivative trades laid out, and I'll get into the derivatives and the trades and stuff, but there's only 2 sets of trades, when prices go up and when prices go down. That's it. Okay, so it's very mechanistic. Okay, there's nothing in between. So if prices go up, there's one set of trades. If prices go down, there's another set. That's it. It's up to you to decide if they go up and down. If they go up, you use that set. If they go down, they use that set. That's it. So in this case, you have indices, exchange traded funds or ETFs, and stocks. Okay, the number here is the number of indices you are tracking, the number of ETFs you're tracking, and the number of stocks you're tracking. In the requirement, you have to have at least 3 indices, so such as stock indices would be the S&P 500, the Dow Jones, and the NASD, the NASDAQ index. Okay, you can have others if you want to. If you want to go to 4, that's fine. I don't care, but you got to have at least 3 of the major indexes. And those are the 3. These indexes are replicated. The stocks that are in the indexes, the stock indexes, there are what are called exchange-traded funds, which actually have securities in them. And those funds are actually traded on the New York Stock Exchange as stocks, just like stocks. But what they do is they mimic these indexes. So they're going to be highly correlated to each other, but the shares of these ETFs are going to be traded on the New York Stock Exchange, so they're going to be actually even more volatile than the indexes themselves. Okay? But they're highly liquid. And this is the new product innovation that's come out over the last 10 years. And if you want to go work for BlackRock and Wells and some Morgan and those guys, they actually created exchange-traded funds based off of a ton of indexes, and that market has just basically exploded. It was like the mutual fund industry when that product was invented in the early 80s. It's just exploded as a product innovation, and is pretty much fully adopted by all investors as of today. So a very successful product. And then the third are individual stocks, which are stocks issued by companies that actually trade on an exchange. The biggest exchange is the New York Stock Exchange, or what is called the Big Board, and then most tech companies will list and trade on the NASDAQ Exchange, National Association of Security Dealers. Okay. So if you are forecasting stock prices going up, and I'll go through the trades. In this case, stock prices are going to drop. Okay, I take that back. Stock prices are going to drop. So this is the trades. You are going to write forward contracts, and I'll go over the forward contracts in a minute. You are going to write futures contracts. You're going to write call options on futures, and you're going to buy puts on futures. That's it. Since you're forecasting stock prices to go down, the ETFs are going to go down too. So you're going to sell these exchange-traded fund shares short. You're going to buy put options, and you're going to write call options. Since you're forecasting the stocks to go down, you're going to sell short, buy puts, write calls. These trades in the ETF box are exactly the same trades in the stock box. There are no futures traded on exchange-traded funds or stocks. Okay, so this is exactly what it is. So 3 times 4 is 12. So you have a total of 12 trades for the indices. 3 times 3 is 9. 5 times 3 is 15, for a total of 36 trades. Right there. Okay, so very quickly, I know what you're tracking, what your forecast is, over what period, what's going to drive those prices down, how many trades you have, what the trades are, what the total trades are, and then you're going to give me in here either some codes and or the ticker symbols for the exchange-traded funds and for the stocks, and you're going to have to do the research and go find those. Okay? So that's basically, bam, right in your face. And then down here, you're going to have bullets, which is going to have information that ties right back to the individual factors that are basically going to support your forecast. So the factors are basically the information and the data is articulated down here in bullet form. And the bullets have to be flush to the left margin. Okay? And then you're going to put in 2 graphs that are going to be symmetrical to each other, not all distorted or anything. They're going to look just like each other, and the data in the graphs are going to go back 2 years, and they're going to either be on an index or an ETF or a stock. And you got to go find from big charts and stock charts and Yahoo, you got to go get the data and put the charts in there. And later on, you may want to go ahead and put some support lines and resistance and some trend lines in there to add in the technical analysis after I train you how to do the technical stuff. So that becomes, the body that actually supports all of this. And then the last part is really, really easy, because you need to tell me again, right? Because most of the investment committee members and the board of directors and senior managers and portfolio guys or gals, are in their 50s and 60s, and we need to be told again, what it is, you're arguing. So you copy the first paragraph, you bring it down to the bottom, and you paste it there. And you only make 2 changes. You change the colon here on the after the trades to a period, and from the following 36 trades to the above 36 trades, so it ties right back. Bam, you're done. You got a template. Then once the template is done, then you can replicate it across oil and gold and bond and US dollar. Okay. So any questions on that? Any questions on the format? Go for it.
On our first try, you just want the format down. You don't
I want the
really care about
format
the
down.
analysis.
I mean, you could replicate this if you want. I don't care. You know, I've given you templates. The format is totally key because nobody's going to read your stuff if the format's all messed up. You know, if your margins are whacked out, or your memo is really small, if your graphs are disproportional, if your graphs are day charts and not 2-year charts. This is a highly sophisticated trading brief that you give a senior executive or a portfolio manager or a senior equity analyst or a CFO, COO, CIO. I mean, this is a high quality business brief. Okay, did that answer your question?
Yeah, I was just asking if you wanted us to actually try to forecast.
Yes. Yeah. Part of the exercise is to get you comfortable in forecasting. Students don't forecast. They always look back. They're backwards looking, not forward looking. Our job is to forecast. We need guidance. My clients want forecasting guidance. They want to know what's going on in the market. They want to know what's going to happen to the market. They want to know what to do. Okay? They don't care what really happened in the past. The past is a good indicator of the future. But I'll tell you, they want to know what's going to happen in the future, and they want to know what's going to happen tomorrow, and next week, and 2 weeks from now, and 2 months, and 2 years from now, because they need to plan, either operationally, tactically, and they want to know what's going to happen 5 years from now, because that's strategic planning, right there. And that's what I'm getting. Those are the calls I'm getting. It's like, what's happening? What do I do? Okay, go for it.
You might explain it, but I may have missed it. How do you indicate the number of trades?
It's going to be the number of indices that you pick, and I recommend 3. On the stock indexes or indices, you can use both, but indices are more appropriate. You're going to pick them. For the stocks, I would use the S&P 500, the Dow Jones, and the NASDAQ. Okay, and then you can go to Fidelity, you can go to BlackRock, you can go to Morgan Stanley, you can go to any one of the top Schwab, you can go to the top firms. And there will be exchange-traded funds that basically mimic those indexes. And you go up there and you go get their ticker symbols, okay? And then you look up, let's say, the S&P 500 ETF or the S&P 500 index, and you find the top 5 companies that make up the majority of the market value of that index. And it's going to be like Google and Apple and some of the top firms. You use those top 5 companies as your 5 stocks. And then you find the ticker symbols for that. If you're doing oil, you're going to find oil price indexes that are going to be created by a lot of these companies, but they're tracking spot prices, daily trades. Then there's going to be oil company exchange traded funds. So there's going to be exchange traded funds that are made up of just oil companies. And then within those exchange-traded funds, there's going to be companies that are listed that make up the majority of those exchange-traded funds. You pick the top 5, and you put the ticker symbols right there. Because they're all going to be correlated. They're all going to be moving in the same direction. Some quicker, some more volatile, but theoretically, they're all going to be moving in the same direction because they're all tracking oil prices, and they're all tracking, in most cases, oil company stock. Okay, so if oil prices go down, for sure Chevron and Exxon and BP, their stock price has dropped significantly over the last year. Okay, does that answer the question? Okay, anybody else on that? Okay, so let's stop it there and let's get into the trades.